Welcome to the deep dive. Today, our mission is pretty straightforward. We're jumping straight into these huge Q3 results from a major global memory chip maker. And the numbers are big, but the really stunning part, they've apparently already secured demand for their entire 2026 product line. Sold out.
Yeah, it's quite something. This deep dive really gives us a crucial look at where all this AI boom talk stops being just hype,
Right.
and starts translating into actual quantifiable financial results. And maybe more importantly, permanent structural shifts in the semiconductor industry itself. This isn't just like one good quarter. It feels like something bigger is happening, a whole new market architecture.
Okay, so let's unpack this Q3 financial. Well, spectacle feels like the right word. FY 2025. The results are genuinely eye-watering. They really show the force of this AI demand. So, revenue first. KRW 24.45 trillion. That's a solid 10% jump just from Q2 and a massive 39% surge compared to last year.
Huge numbers. But the real story here, I think, is profitability. This company didn't just sell more chips. They sold much, much more expensive ones. Operating profit hit KRW 11.38 trillion. That's up 24% quarter over quarter, right? And 62% year over year.
62%.
And wait, the net profit? This number just exploded. KRW 12.60 trillion. That's an 80% jump from Q2, and get this, 119% higher than the same quarter last year.
Okay, hang on. Net profit, 12.6 trillion on 24.4 trillion revenue. That puts their net margin over 50%, like 52% roughly. In the memory industry, which is known for being so cyclical, doesn't a margin like that usually signal, an overheated peak, something that's almost impossible to sustain? How do I know this isn't just another temporary bubble?
That's a really fair question, especially given the history. But if we look a bit deeper than just the headline net profit and drill down into the operating margins, you start to see why this might not be a traditional cyclical peak. Their operating margin reached 47%, and the EBITDA margin hit 61%. These are extreme numbers, yeah, but they're only really possible because of the product mix. The company explicitly said performance was fueled by strong sales of leading-edge products such as HBM, high-performance DRAM, and eSSDs. These aren't your standard memory chips. They command substantially higher prices, average selling prices, or ASPs.
Ah, okay. So the mix is the key differentiator here. It's not just selling more volume of the same old stuff. Let's look closer then at those core memory categories you mentioned. DRAM first.
Right. So if we break down the performance, it gets clearer. DRAM bit growth, that's basically the volume sold. BG was up high single % quarter over quarter. But crucially, that volume growth came alongside the average selling price, the ASP, being up mid-single % quarter over quarter.
So selling more and getting significantly more money for each unit.
Exactly. They're hitting on both cylinders there.
And what about NAND? That's typically used for storage, right? How did that perform?
NAND was, a bit different, which actually tells an interesting story about where the main AI investment is still focused. The volume growth, the BG for NAND, was actually down mid-single % quarter over quarter.
Oh, okay. So volume dipped.
Yeah, but here's the thing. Even with that slight dip in volume, the ASP, the price they got was up low teen % quarter over quarter. So it confirms they're successfully raising prices pretty much across the board. And they seem to be prioritizing profitability over just shipping volume, especially by pushing those high-performance enterprise SDs, the eSSDs.
Got it. So that Q3 performance is, a really strong signal about the current market. But what really makes this deep dive necessary, like you said, is the forward guidance. That's the part that seems to fundamentally change how we look at this company and maybe the whole sector.
Absolutely. The financials show you the current strength, no doubt.
Yeah.
But it's the guidance looking forward that really points to this structural shift we're talking about.
Okay, here's where it gets really interesting. The core statement from the company, they've secured customer demand across all DRAM and NAND products, including HBM, right through the entire year 2026. Selling 2 years of your whole manufacturing output across every single product line. That's just something you don't normally see in the memory market, right? It's usually so competitive, so volatile.
Oh, you really don't.
Yeah.
Selling your full capacity 2 years out is, it's almost unprecedented. You might have to go back maybe to the early days of the internet boom to find parallels in tech. And even then, it wasn't driven by a single technological shift quite this demanding. The memory market is famously cyclical. Customers usually wait for the price dip. The fact that major players are committing now, locking in supply for 2026, tells you they don't think that dip is coming anytime soon, at least not for these critical components.
That level of confidence is just remarkable. Okay, before we dive fully into that dramatic 2026 forecast, let's quickly touch on Q4. I mean, given the 2026 outlook, they must be expecting just exponential growth right now for the next quarter.
Actually, no. And that's what makes the 2026 commitment stand out even more. The near-term Q4 guidance is, well, moderate. The expectation for Q4 bit growth for both DRAM and NAND is only a low single% increase quarter over quarter.
Okay. Why so cautious?
They mentioned macroeconomic uncertainties as a factor, so they're not totally immune to wider global concerns, obviously. However, they also said they're confident that the growing adoption of AI functions will keep driving overall memory content growth, kind of regardless of temporary market wobbles.
Okay, so Q4 looks stable, maybe a bit cautious, but then 2026 is where the fireworks are. What are the specific demand growth numbers they're forecasting? What justifies locking up all that capacity 2 years from now?
Yeah, the long-term forecast is truly staggering. For DRAM, they expect demand bit growth to actually accelerate. They're forecasting growth of over plus 20% year over year in 2026.
Over 20%.
Yeah, I mean, just for context, growth rates like that are usually what you see in like startup phases, not mature trillion-one industries. And that's up from an already strong plus high teen% forecast for 2025. And it's not just DRAM. For NAND, demand BG is expected to hit plus high teen% year over year in 2026. Again, up from the plus mid-teen% forecast for 2025.
Okay, that raises a huge question, though. We know HBM, the high bandwidth memory, is driving some of this, but HBM is still a relatively small percentage of total memory bits produced, right? So why is the entire product portfolio, including conventional DRAM and NAND storage, also secured for 2 whole years? What kind of spending, what architectural changes are driving demand for all these memory types at the same time?
Right, and that's really the crux of this structural shift idea. It seems the drivers are all tied to how AI models and their workloads are scaling up, and crucially, how they're being distributed. First, you've got the shift towards AI inferencing that's actually running the trained models, not just training them.
Yeah.
That's dramatically increasing the number of concurrent users, the number of tokens being processed simultaneously. And second, these AI server workloads aren't just staying cooped up in those super expensive centralized AI training boxes anymore. They're being distributed out to general-purpose servers, even edge devices, all over the place.
All right, so the intense demand for the super fast HBM forces a kind of necessary cascading demand for slower but higher capacity memory to back it up. Is that the idea?
Precisely. Yeah, the technical mechanism here is really key to understanding why the whole inventory is sold out. Memory usage is apparently increasing exponentially because of something called sequential offloading of the KV cache.
KV cache. Okay, break that down a bit.
So for listeners maybe not deep in AI architecture, the KV cache is basically the temporary memory that these huge complex generative AI models need. It holds things like conversational history or the context for the current request.
And this KV cache, it gets too big to stay entirely on the fastest, most expensive memory like HBM.
Exactly right. The cache ideally sits on HBM, that ultra-fast stack memory, because you want it close to the processor. But because the context windows for these models are just getting enormous, the cache often overflows. It has to be moved sequentially to the next fastest tier, that's usually high-performance DDR5 DRAM. And then if it's still too big, it gets offloaded again to high-capacity, high-throughput enterprise SSDs, those eSSDs. So this whole offloading process, combined with handling many user requests at once, it's causing a structural demand surge across all those memory tiers, HBM, DDR5, eSSD. It fundamentally changes the amount and type of memory needed per server.
Ah, okay. That totally connects the dots back to the Q3 results, why the sources specifically highlighted strong sales of eSSDs right alongside HBM. The demand isn't random. It's, like you said, architecturally mandated by how these AI systems work. And speaking of HBM, you mentioned leading-edge products. This company isn't just sticking with the current tech, are they?
No, absolutely not. They're moving fast to keep their edge. The sources confirm they have really ambitious plans. They intend to start shipments of HBM4, that's the next generation, higher speed, better performance in Q4 this year.
This year? Wow.
Yeah. And then they plan to ramp up full-scale HBM4 sales throughout 2026. This isn't just about selling chips off the shelf anymore. It sounds like they're co-developing the future AI infrastructure with their biggest customers, which, explains why those 2026 supply deals are already locked in.
Okay, so to fund this massive expansion, this technology race, and meet that sold-out 2-year demand, they need a really solid financial foundation. Let's look at their ability to actually pay for all this, because it seems like those strong earnings are translating directly into serious financial muscle.
Oh, absolutely. They're practically swimming in deployable capital right now. In Q3 25, their cash and cash equivalents figure surged to KRW 27.85 trillion.
27.85.
Yeah, and that's up dramatically from KRW 16.96 trillion just one quarter earlier in Q2. They're basically converting those premium HBM and eSSD profits into readily available cash at an incredible rate. That gives them maximum flexibility to invest.
And it's not just cash on hand, right? Their overall debt situation has improved significantly too, makes the balance sheet look even healthier.
Yeah, exactly. Look at their leverage. The debt-to-equity ratio, which is a key measure of financial health, has improved dramatically. It dropped to just 24% in Q3 25. That's down quite a bit from 32% in Q3 24. So this financial stability, this strong balance sheet, it allows them to be extremely aggressive with their capital expenditure plans, their CapEx, without really straining themselves financially.
Right. So how are they planning to spend that cash then to meet this incredible, already sold out 2026 demand? The investment plans must be accelerating just as fast.
Their strategic commitment seems crystal clear. Year 26 CapEx is planned to increase year over year, so more spending next year too. They emphasize maintaining investment discipline, but also accelerating capacity growth specifically to meet this demand. Specific plans mentioned include opening their new facility, M15X, ahead of schedule. They're apparently starting equipment installation immediately to speed up getting that new capacity online.
And they're also pushing on the technology side too, right? Migrating to newer manufacturing processes to keep costs down and performance up.
Yeah.
What were those nodes again?
Right. They're accelerating tech migration to what they call 1CNM for DRAM and 321L for NAND. Now, those specific codes refer to their leading edge in manufacturing density. Smaller transistors, more chips per wafer. That's how they maintain cost and technical leadership. And critically, because of that whole KV cache offloading mechanism we talked about, they specifically mentioned prioritizing capacity support for those high-capacity eSSDs, making sure they can serve the entire memory stack demand that these AI servers are creating.
Okay. So let's try and pull all this together. We've got record profits, incredible margins driven by premium products, and this almost unbelievable sold-out status through 2026. What does all this signal for you, the listener, whether you're an enterprise customer or even just an average consumer?
Well, I think these results clearly signal a market where the demand for this advanced AI-specific memory, HBM, high-performance DDR5, eSSDs, it's starting to structurally decouple from the traditional macroeconomic cycles we're used to. The needs of AI infrastructure are immediate, they're seen as essential, and they're absolutely paramount to the biggest corporations on the planet right now. It seems they'll pay almost any price to secure that supply.
So it's a market being driven more by technological necessity than just broad economic sentiment.
Exactly. And, here's maybe the final provocative thought to leave people with. Given these aggressive demand forecasts, remember, DRAM over plus 20% year-over-year growth expected in 26, and the fact that this company's entire 2026 lineup is already secured, presumably by premium AI-focused customers, well, their intense focus on these high-margin, high-performance AI products must inherently constrain the manufacturing capacity that they allocate to more conventional memory chips, right?
Yeah, that makes sense. Finite capacity.
Right. And we know from the sources that prices for traditional memory, the stuff needed for regular laptops and phones, were already raised for the fourth quarter. So the question is, what does this aggressive structural capacity constraint, this big shift in priorities towards AI, what does that imply for the price and maybe even the long-term availability of those conventional memory chips? The ones needed for standard PCs, mobile devices, all the everyday consumer electronics, in the coming year or two. That potential scarcity, driven by this AI supercycle, sucking up all the advanced capacity, that could be the next major ripple effect for the mass market.
That's a fascinating and pretty crucial insight, how the hunger for the most advanced chips could end up dictating the price and availability of everything else down the line. Thank you for guiding us through this deep dive. Those results and that forward guidance are really something else.
My pleasure. It's certainly a dynamic time in the industry.
And thank you all for joining us. We'll catch you on the next deep dive.